is this market printing? The trend truly continues to be our friends. My portfolio at all-time highs today, and I want to talk about some of the crazy warnings, concerns, everyone really fixating on these real giants in the ETFs realm like Ray Dalio or Kathy Wood, because they've been adjusting their portfolio and people are like making these like there's some kind of warning against a market correction, when really the biggest thing that we're going to be facing in the market is what they call tapering. And I'm going to explain to you what that is, because it's a huge proponent of what you're going to be hearing a lot about over the coming week and over the coming few months. But the first thing I really want to fixate on is Ray Dalio's portfolio, because I can't get over the amount of investors out there that keep claiming that, warning this, warning that, Ray Dalio selling down the SPY, must be bearish. And when we look at Ray Dalio's stock performance, which I'm just grabbing off Finbox, you can actually take a look. I think his fund is public. You can kind of see all this stuff. I kind of like how this little Finbox kind of shows it here, because his portfolio has just recently started underperforming the general market. And when I scroll down and actually take a look at what this guy's holding, I don't like these companies. And I'm going to explain to you why, because they're great companies. They're like PPCE and those dividend juicy investors looking for that retirement, that stability, that stuff that really suits the old style Ray Dalio kind of investing. But from a growth perspective, or somebody that wants to get real returns out of their portfolio, I don't particularly enjoy this kind of format, because he's highly weighted, still about 5% in the SPY, which he has reduced over the last couple weeks. I mean, he's got Walmart in here. He's got what is this? The Vanguard International Equity Index Fund, so some international exposure. You got Procter and Gamble in here, J&J, Coca-Cola, Pepsi, like these real consumer stapled brand type companies. But what he seems to be underweighted in is tech, and his only exposure to tech is through the S&P 500, right? And this kind of blows my mind. And let me explain to you why by looking at some of these heavy weightings in Procter and Gamble and etc., right? Because Procter and Gamble's year-to-date return has been abysmal at best. Let's be real here, folks. Up 3.52%. If you slap the yield on and this thing flatlines into the end of the year, you're barely looking at a 6% return with a PE of 25. You're paying a pretty hefty premium for a very lackluster of growth. And I mean, you just take a look at the total revenue expected, and they're really not expecting to grow too much this year, right? And it's okay. I mean, these are great foundational companies for long-term stability. I get it. But again, look at something like a Walmart here that's trading at a PE of 40. With a 1.4% yield and absolutely no capital return. And when we look at the growth this company is expecting on their gross profit, guys, it's not exactly thrilling. It's not exactly exciting here. And I mean, how do you expect Costco or Walmart or Procter & Gamble to grow like a tech stock? They just don't have the fundamental business of a brick and mortar type business to just double their revenue in a year, right? I mean, look at J&J. This is one that I personally hold, trading at a PE of 26, more exposure to healthcare, which is keeping up with those market average returns. I hate that term so much. 8% market average. No, the market average return has been about 20% for the last 10 years. If you want to scale that out over the last, since the 1930s or whatever, then by all means. But let's just talk about the reality, the macro here, because we're trying to compete in performance. And, you know, you're looking at a 26 PE, that 2.4% dividend yield, and Johnson & Johnson falls in the same category, where you're not getting like this kind of crazy explosive growth on their gross profit. You're just not getting it. So if you're in a retirement age, you want dividends, it's great. There's nothing wrong with that. But at the same time, how do these people not recognize, or maybe they do recognize and it's just something that I'm missing, but is Facebook really trading for that high of a valuation that it's too expensive to like be buying into over something like a bloody Walmart that isn't going to double their store revenue in the next few years? That'll never happen. But like Facebook, guys, is trading for $381 a share today. It's 28 PE, which is in very range bound to these other consumer staple brands. But look at the bloody revenue growth here, guys, from 2018 to 2020. I mean, its revenue is up over like 50, 70%. The gross profit is just exploding through the roof, doubling in the same few year period. Like, this is astronomical to me, guys. Like, I don't know how else I can state this, but I just don't understand, like, the structuring of his portfolio and just the real lack weighting in tech, where Kathy Wood's on the whole other board of the spectrum, and she only wants to be in tech realistically, because, again, guys, like these, you can't argue these growth numbers and to say, oh, it's just going to stop, these PEs are going to come back into fair value. I'd arguably say that most of these PEs on these tech giants are at fair value, especially if you have like a 5 or 10 year time horizon. And when you're looking at a 41% return, do you really need that much investing in like these consumer staple brands when you could just liquidate some of these shares for cash flow or even do options trading to cash flow these suckers. So let's talk about what might actually be affecting these companies in the near term, because this is something most people do not grasp. I promise you this is going to be something you're going to hear about a lot, but it's tapering, right? What is tapering? Well, it is the reduction of the rate at which central banks accumulate new assets on its balance sheet under a policy of what is QE, quantitative easing. Tapering is the first step in the process of either winding down or completely withdrawing from a monetary stimulus program that has already been executed. So we all know since the pandemic, the government, the central banks have been pumping money into the economy. They buy a lot of assets. They're probably buying the general indexes, which is what is offering this stability and growth. And as of recently, folks, I mean, we have heard that Powell sees taper by the end of the year, but says there's much more ground to cover before a rate hike. So what I want to do real quick is there's a guy on CNBC that I love listening to because he's been really bullish on tech, the S&P, and he kind of touches base on where he sees the market going and his own personal concerns. So just take a listen.
You know, we are seeing things where more investments coming, whether it's people moving to the suburbs or supply chains moving to America. These are really big structural changes, and maybe they hurt companies outside the U.S. So I think it's a really important question, you know, once accommodation sort of starts to come off. But I do think it's not something to say that the entire stock market will, you know, have the rug pulled out from under it.
Interesting. So what do you think is going to happen with the broader stock market? As you listen to Fed officials speak this week, Chair Jay Powell speak today, have you changed your assessment for what the stock market looks like moving forward?
I think the stock market in 12 months is in great shape because we're in the midst of an expansion, and there's a lot of pent-up demand, and there's, for the first time in a long time, you know, real demand growth. But it would be incorrect to say stocks will sail through a Fed tapering easily. I think I think everyone should brace for a period of volatility, and then it's hard to tell if that sell-off starts before the Fed because the market's anticipating it, or if it's in response to the Fed. But I would expect a lot of turbulence, yes.
Apparently tapering is going to offer some kind of volatility to the market because obviously it takes away that stimulus, that stability, leaving it up to retail and institutional investors to continue buying the assets. So I would expect this trend to stop going up as consistently if this is primarily the reason that's driving it up. But I mean, this is really hard stuff to talk about because I mean, we're talking about trillions and trillions of dollars, and for the S&P to just move up 20% in a year is an astronomical movement, right? But the fact of the matter is, I still believe we're in this incredible growth cycle like these guys on CNBC relatively believe, and I'm not going to sit here and tell you to be afraid of this market. I mean, realistically, these are the safest investments you can possibly make in the world, and so many people are chasing small caps right now. They're trying to suck you into these lower valuation stocks when clearly the rotation continues to be in large caps because, again, guys, when you got a company like Facebook that's going to do more bottom line than any small cap you're ever going to get, and they're going to be able to continue to invest those dollars into the metaverse or whatever. And this is just Facebook as an example here, guys. It just doesn't make as much sense to be totally waiting in small caps unless you believe they have a true competitive edge. And don't get me wrong, I work with a lot of smaller cap companies, international companies, and they have some huge potential. And I think having some of that exposure can really help in the near term because obviously if those companies start really proving out those cash flow capabilities, it should reflect onto the stock price, giving you maybe a quick doubling in the market. But I would be careful how you mitigate those because, guys, the path of least resistance to wealth still seems to be the S&P index. And I mean, that is proving true as a statement, especially in my portfolio, which makes me want to ask you the question, when do you think this stuff slows down? These 20% returns are literally going to fast track your retirement by decades if this lasts for even 5 or 10 years and you are really hammering more than like the average amount of say $500 a month to an investment portfolio. So I want to know what you guys think specifically on what's the time frame. Are you more concerned? Are these red flags from Ray Dalio concerning you? Like, is all this stuff kind of encapsulating to you that I should be a little bit more concerned of the market, or is it a thing where, you know, we're still going to get a few months of this quantitative easing before interest rates and tapering happens? And, you know, if you can get another 10 or 20% return, which is what I've experienced in the last 4 months buying Facebook and these companies, that even if it drops, you now have a cushion, right? It's just a matter of how long does this last? And, you know, I'm going to continue to say the trend is your friend, and I'm going to be surely a part of it. So stay cool, stay awesome, and I'll catch you tomorrow.